everyone, welcome to today's lecture. The topic of today's class is microfinance. So before I get into the topic in a greater detail, let me just give you a brief snapshot of what I'm going to cover in this entire lecture. So here I'm going to revisit the idea of formal credit market and informal credit market. I would also explain why microfinance is relevant and what are the various features of microfinance. And I'm going to end the class with a case study. I'm going to focus in a detailed case study of microfinance in this particular lecture. So what are the learning outcomes you can expect once we are done with this lecture? So you would understand that information asymmetry actually plays a very crucial role in credit market. Other than that, we would also understand how formal and informal credit market may not be sufficient to give the loan to the extreme poor population in any society. In addition to that, you would also understand the relevance of microfinance and what are various features of microfinance. So once we are done with this lecture, please check whether you can answer all these questions or not. Moving on, since microfinance is again a kind of a credit market scenario, and particularly for rural sector, so what I'm going to do, I'm going to focus on again rural sector, right? So what is rural sector? How do we understand rural sector? So we can understand rural sector by focusing on the type of activities do generally takes place in the rural sector. As you can see on the photos of the left hand side of this slide, it's basically someone is doing the farming work. So this is actually comes under rural farm sector. On the right hand side, you can see a market. So market where it's like a kirana shop or maybe retail marketplace, which would be known as a rural non-farm activity. So rural sector, farm sector, as well as non-farm sector. Now credit market, right? Credit market, you have some idea of the credit market. In any market situation, we can understand, we can focus on one is the demand side, another is the supply side. If I'm focusing on the supply side, who are there? It's basically the banks. And on the demand side, who are there? If I'm focusing on the rural market, so basically the rural household. So what are the purpose of this loan? So loan might be production loan. So you are taking loan for production or you are taking loan only for consumption. So it might appear the interaction between bank and a person. So bank is giving loan to a person, right? So it might appear there's a very simplistic form of interaction. Nothing is there. There is a bank and there is a person. Person has gone to the bank and bank is giving out the loan to the person. But it is always not the case. So bank advances money and bank is thinking whether I'm going to get back money or not. Even if it appears to be very simple, but it is not. Let us unpack the story here further. Let us focus on the borrower. So borrowers are like individual like us, right? So it's like human being. We're talking about human being. So human being could be risk lover. They could be risk neutral, risk averse. Human being could be lazy, right? Human being could be very active and individual could be very active. Individual can take loans for a particular project. They may think, okay, fine, I don't want to invest in this project. Let me spend the money in something else. Maybe I'm consuming maybe a luxurious product. That can also happen. So the point I'm trying to emphasize here is that it is just not possible to understand how a human being is going to behave. We are not sure about his behavior, right? Other than that, the individual who has taken loan, they can also think that I have taken loan, I will just leave the place. I don't care. Okay, so these are a couple of things which we can't say about any person beforehand. Now, what bank will think? Bank is flooded with questions. Bank is thinking, the first thing bank will think, is my money in safe hand? Because I have given you the money, right? Think about it. Like if you're going to lend some money to someone, you'll always think whether I'll get back the money, right? So I think bank also in a similar kind of situation. Bank will always think, is my money in safe hand? Whether the borrower is a risk averse or lover, what is happening to my money? Am I going to get back my money? These are all sorts of questions bank is going to think. Okay, so as you can see from the both side, there are a lot of questions, and mostly bank does not know lot of things about the borrower. So the center point here is the about information. Bank does not have information about the risky behavior. Bank does not have information about the effort. Bank does not have information about the risk of default. Okay, so it is in this context I'm going to introduce two important concepts. One is moral hazard and another is adverse selection. This is from bank's perspective. Bank is thinking, okay, I am giving the loan, but since bank does not know what type of project the loan is going to get invested, and bank simply does not have any mechanism to deter the borrower for taking the risk, right? So bank at max asks for you lot of documents which might verify your, let's say, identity, but there is no such document the borrower can provide where it would be written that, okay, I'm not a risk lover or I'm a risk lover. So this concept is known as moral hazard. Similarly, another perspective from bank's perspective is called adverse selection. So there are risk lover person, there are risk averse person, but bank does not have any mechanism to distinguish between these two, right? So bank is giving money to, bank is thinking everyone is similar, right? And charging similar amount of interest. So what is happening? So risky borrower is also paying the same amount of interest. Safe borrower is also paying the same amount of interest. So bank does not have any mechanism to distinguish between these two sets of borrower. This is called adverse selection. Now, going back, so what is happening? Again, there are two sorts of risks. So information asymmetry is there, and since there is information asymmetry, what is happening? There is risk of default. There is strategic default, there is involuntary default. Strategic defaults are those default where people are taking money and they're just simply not bothering to repay back the money. That is called strategic default. And it would also happen particularly in those cases where your legal systems are not very strong, where your legal systems are very weak, right? And what is involuntary default? Involuntary default are those default where person want to repay back the money, but due to some external reason, it could be, let's say, flood, it could be crop failure, or it could be anything. The project, whatever project the money was invested, let's say the project did not take place, even if the borrower has put lot of effort on the project. So that is called involuntary default. The borrower wanted to repay the interest and repay the loan, but they could not do it. So since there is strategic default, since there is involuntary default, and there is lot of risk involved, what the bank would always ask? Bank would always ask for collateral. And what is collateral? Collateral is generally any form of asset. Now, just to give you this summary, so far what have we done, particularly for this formal credit market? So there is a borrower, there is a lender. There is a relationship between lender and borrower. There is also information asymmetry. And since there is information asymmetry, since there is a lot of risk, so that's why bank is asking for collateral. Just remember one slogan here: no collateral, no business. So you don't give collateral to the bank, bank will say, okay, bye-bye. I'm not interested in any kind of business with you. Now, let us just focus on the idea of collateral a little more. We are focusing on the real sector, right? And we know that collateral is a kind of asset. So any kind of asset could be, let's say, land could be a very important asset, right? So here in this particular table, I would like your attention here on the last row where it is written above 10. Above 10 means the person who owns land more than 10 hectares. Now go to the last column, rural household. There are only 0.2% rural household whose land ownership exceeds more than 10 hectares. That is, big landowner are very less. There are not many big landowners, right? On the contrary, now let us go to the first two row where it is written less than 0.01, that is less than 0.01 hectare. Correspondingly, last column is that 12.7%. So there are 12.7% rural household who own less than 0.01 hectare of land. It's a very small quantity of land. Again, the next row, that is 0.01 to 0.40, not even 1 hectare. How many rural households are there? What is the percentage? 50.2%. So around 63% of rural household, they own very small amount of land, and that cannot be given, that cannot be considered as collateral. Bank just not going to take this sort of collateral. Okay. Not only that, there are also landless rural household. The data shows there are 8.2% of rural household who don't own any land. So we are talking about the collateral. If you can't have the asset, then you can understand that you are already getting excluded from this formal credit market. Moreover, another important point is that what is the average landholding size is 0.512 hectares. It's not even 1 hectare. So just to emphasize here that most of the rural household, even if they have land, they have a very small plot of land. And even if you're giving or presenting this as a collateral, what would happen in case you default, it would be very costly for the bank to go to the interior village and to take that collateral. Okay, so the transaction cost would be very high for the bank. So the point is, most of the rural household, they don't have sufficient amount of collateral to get included into the formal market. Now the question I'm going to ask here, there are a couple of questions here. So what would happen if no one is, let's say people don't have any collateral, but they need credit? What would happen if people have some asset, but that is not sufficient enough? It is in this context, do we need to think some alternative credit system where this collateral business can be taken care of? Do we have to think of something else? So think about it. I'll get back to you. Okay, the question I asked previously is that if we have the problem of collateral, then what should be done? So it has been observed specifically this problem can be minimized if you are going through this informal credit link. What is happening there? They don't ask directly for a collateral or a, let's say, asset, but their collateral can be very different. Let's say it could be your labor, it could be your land contract. Okay, but one important feature of this informal credit market is that the rate of interest in informal credit market is greater than the formal credit market rate of interest. Why? Because risk of default is also existing here. It is not eliminated. But the advantage of informal credit market is that the person or the lender actually have much more information about the borrower. That is why they are not asking for asset or collateral. Okay, moving on. So what has been observed that this informal credit link can be worked in a following way. Trader can give money to the farmer, or landowner can give credit to their tenant or either to the agricultural worker. It is always easier to enforce, and it is always, the cost of monitoring is always less. So that is why even if there is no collateral, this sort of informal credit market can exist. Okay. Now, I would like your attention to this particular table. It shows average monthly income and consumption of this particular land size, because we are talking about collateral, right? Now I wanted to show that what about those person whose land holding is very less? What is their income? How much is their consumption? As you can see, then the first two rows, which shows actually land holding is around or less than 0.01 hectare, or land holding 0.1 to 0.40, both these rows, their income is not even sufficient to meet their consumption. They are land poor, as well as income wise also it shows they're in a relatively very difficult situation, as their income is not sufficient to meet their consumption expenditure. So you can see, even if people don't have collateral, but they need credit even to sustain their livelihood. Also, there are a lot of research which has been going on, and it shows this specifically this poor strata of this rural household, what is happening with them. Their real average income, it witnessed negative growth. So basically the bottom of the income distribution in the rural areas, they have witnessed decline in their position. So their real income is going down, and this is not a good scenario, right? It shows that credit is needed for them. Consumption credit is also needed, and if they have some production credit, they can sustain their livelihoods. So two major issues as a policymaker will face. Two major issues. There are two challenges. One is, how do you address this kind of poverty? They are land poor, also their income is not sufficient. How are they going to address this? Along with, how are going to address the issue of information asymmetry, because that is, anyways, it is very crucial for any lenders, right? So we need to come up with such kind of policy. So this low income household, they need financial services just to take them out from the poverty. So at this point of time, I would like you to think the following question. So what would ensure that this low income household, they get credit, and also information asymmetry, that also get, we have to think such kind of policies which actually take into account both these aspects. One, information asymmetry, and second is, supplying the loan to this rural poor. So can we have those kind of strategies or those kind of financial services in front of us? That is the question. Please think about it. I'll get back to you. What is the need of the hour? So need of the hour is, we should have such policies which actually takes into account both these challenges. One hand, it addresses the poverty, and on the other hand, it also takes into account this information asymmetry, where this micro information should be there with the lender so that they don't go out of the business, right? We have a good news, by the way. We have a policy or a financial service called microfinance. So what is microfinance? Let us just focus on this slide. So microfinance is a form of financial service which provides small loans and other financial services to poor and low-income households. It is an economic tool designed to promote financial inclusion, which enables the poor and low-income households to come out of poverty. So the point is, we have a policy. It is just not like formal lending or informal lending. It is actually targeting to the poor people so that they have some amount of income, so that women have empowerment, and so that they get included into the credit market. And what is the policy? The name of the policy is microfinance. Now, what are the features of microfinance? Just focus on this point. So these are group lending, peer monitoring. We don't need any collateral. It is also profitable for the lending institution, and it excludes the risky borrowers. So these are a couple of features. Just remember the points I'm going to explain in a moment. So remember, in formal borrowing, we were tensed about that. What if the risky borrower is included? And in formal borrowing, one important feature was the bank was giving only to one individual, right? That was a one-to-one interaction. Here, in this particular financial service called microfinance, we have group lending. So instead of giving loan to one person, the loan is given to the group of individuals. And again, since it is given to the group of individuals, so the group decides who they are going to include as members. So they generally don't include the risky borrowers because they have much more information, right? And the third part is the monitoring also. For the formal bank, they had to monitor if they're going to give the loan, or in fact for the informal money lender as well, they had to monitor. Some sort of monitoring was there. But since here the loan is given to the group, so the group will do the monitoring. So it's like a peer monitoring. So it's very different from the formal lending setup, right? Also, it addresses two problems which I raised in the previous slide. One is adverse selection and another is the moral hazard. So as I was saying, that risky borrower will be excluded in the process since peer monitoring is there, right? But bank could not do that. But in case of microfinance, it is very much possible. And again, moral hazard can also be solved because since it's a group lending, so group can always influence the project decision, that which project the group should invest. That group can always influence. So in a way, they are also taking into account adverse selection and moral hazard, which was very much a problem in the formal credit market. Now, the next question. Theoretically, I understood, yes, it is a very good policy. But do we have any real life example for this? Just browse through and we'll get back. Yes, the good news is there are real life examples. In this context, I'm going to present one case study, and this case study is from Bangladesh, and it's called Grameen. So Grameen is actually set up, it's a very well-known and well-celebrated policy in Bangladesh, and it was set up by well-known economist, Nobel laureate Muhammad Yunus. So Muhammad Yunus, he started experimenting with lending to poor people around in 1976, and that time Bangladesh just got independence, so it was like a huge poverty in that country that time. Okay, so what he was doing, he was paying out of his pocket to the poor, and he saw that okay, he was getting the payment back, and so loan amount was very small. It was around $100. And what was the purpose? He was giving for very small activities. For instance, let's say for rice husking or bamboo weaving, etc. So that's how the Grameen actually started in Bangladesh. Now, what is structure of Grameen? As I said, microfinance is a group lending. So here, every group consists of 5 members, okay? And there is a center, and center has altogether 40 people. That means 8 total groups. 8 groups, each group consists of 5 members. Now, how does this loan disbursement happen? So, loan disbursement happen in the following way. First, loan would be going to the first 2 borrowers. Second round, next 2 borrowers. And the last round, the last borrower. That's how the loan disbursement has happened in Grameen. What was the rule? Rule was, if one person default, entire group has to take the responsibility. That is the main rule. If one person default, the group has to pay. Okay? And if no one's default, well and good, the loan cycle will continue. And if the group fail to repay, then loan will be stopped. Loan won't be provided further. Repayment, yes, repayment happened 1 week after the initial loan disbursement, and repayment happened every week in front of the center. So it was like in front of public, right? So 40 people, their repayment will happen. What is the customer base? The good point is that customer base was 95% are female customers of this Grameen Bank. And loan size, they started with very small loan size, but if the repayment continued, then the loan size also gradually increased. Yes, so Grameen was a very well-known policy measure in Bangladesh. It was recognized worldwide. What happened over the years? So Muhammad Yunus started in a small village, but it spreaded over the entire country. And as you can see from this particular diagram, so membership has increased like anything. So from 1976 till 2000, so it was around 2.5 million people who are members of Grameen. Now the point is it only Grameen, or do we have any other kind of microfinance in various other countries? Point is, yes, we have. After Grameen success, it was, as I was talking, that it actually spread it over the world. So here I am talking about 3 countries. One is Bolivia. Bolivia had another microfinance name called Banco Sol, and the clientele was largely non-poor, and definitely they had also group lending. Indonesia also has this bank Rakyat Indonesia, clientele again largely non-poor, but they did not have group lending. It's a bit different. So microfinance program, there are various characteristics. For us, let's say for India, we have seen that India also, the rural poor, they also required credit. So the Indian government or India also experimented with microfinance, but here the connection or the linkages were between self-help group, NGOs and formal banks. Poor people, mainly women, were included in this microfinance program in India, and it is mostly experimented in the southern part of the country. And group lending contracts, yes, it was again group lending contracts for India as well. As Grameen was very successful and as it was like spread all over the world, what happened that total number of microfinance institutions started, its numbers started shooting up, right? So from 1997 to 2002, total number of institutions actually rose from 618 to 2572, okay? And total number of clienteles, it reached from 13.5 to 67.6 millions, by the way. And also, not only that, it included also the number of poorest clients. So it increased from 7.6 to 41.6. So it just shows that microfinance is actually, it could be a very successful program, a successful financial service which can take into account this rural poor's need and also take into account this information asymmetry problem, which was very crucial for both formal sector lending and informal sector lending. So where bank could not reach out, even if the government wanted to reach out. So when bank could not reach out, it's actually the program like microfinance which actually helped the rural people worldwide. And we are very thankful to Muhammad Yunus for this particular program. So because he only started with this experimentation. So we are at the end of the discussion. So just to give you the snapshot, so whatever we studied in this particular class. So we started with formal credit market, and remember the slogan, no collateral, no business. So formal credit market said, no, we are not going to do the business with you if you can't provide us with the asset. So again, that was a very problem for landless or poor people in rural areas because they really don't have any kind of a collateral, and the things they have, bank did not accept as a collateral, right? So the alternative mechanism was you pay high interest, get into the informal credit market. But that is also could not be sufficient for the extreme poor population where they don't even have sufficient income to meet their expenditure. So in this context, we talked about microfinance. In this context, microfinance was introduced, and the well-celebrated features are group lending, peer monitoring, and it also exclude the risky borrowers. And it actually, microfinance could reach out to the poorest of the poor or the most needy population in any country. So with this, I'm going to end this lecture. Thank you.